Let's be honest, we all have that dream, right? Picking that one stock that just completely takes off. It's exciting to think about. But here's the thing. For every one of those success stories, there are a ton of companies that just crash and burn. So the real skill isn't just about finding the winners. It's about getting really good at spotting the losers before they can do any damage to your money. The legendary investor Peter Lynch absolutely nailed it with this. When you buy a stock, you're not just buying some random ticker symbol that blinks on a screen. No, you're buying a piece of an actual business. And that's our whole mindset here. We're going to stop thinking like we're buying lottery tickets and start thinking like we're business analysts.
So that's the million-dollar question, isn't it? With all the flashy headlines and hot tips flying around, how do you actually see what's going on behind the curtain? Well, that's exactly what we're going to break down right now. Think of this as your framework, like a set of X-ray goggles to spot the warning signs that most people completely miss.
Okay, so here is the game plan. We've got 5 key areas we're going to investigate. We'll start at the top with the people in charge. Then we'll get our hands dirty with the numbers. After that, we'll look at the company's strategy, cut through all the hype, and finally, check if they actually care about their owners. That's you, the shareholder.
First up, and this might just be the most important red flag of all, the quality and frankly, the integrity of the people running the show. You can have the best idea in the world, but if you have bad management, it can all fall apart. So this is always where we have to start.
So what are we actually looking for? Well, a revolving door of auditors, that's a huge one. It might mean they keep finding things the company doesn't like. Keep an eye on massive executive salaries that have nothing to do with how the company's actually performing. A super complicated web of subsidiaries can be a great place to hide problems. Oh, and watch out for independent directors suddenly quitting or for the company issuing special shares only to the founders. These are all signs that management might not be playing a straight game. Now, here is a massive one to watch for. Related party transactions. This is when the company makes deals with, say, the CEO's brother-in-law or another company that the founder happens to own. Now, these aren't always illegal, but they can be a super sneaky way to pull money and assets out of the company, right out of the pockets of regular shareholders like us. It's a huge, huge red flag. Okay, let's move on from the people and get into the numbers. A company's financial statements, they're like its medical chart. They tell you the real story of whether it's healthy or sick. You just have to know what you're looking for. And the first major symptom to spot? Rising debt. A really good company should be like a cash machine, right? It should be making enough money to pay down its debts over time. So if you see a company bragging about its amazing sales, but its debt is just piling up even faster, that's a serious problem. I mean, just look at this trend here. The cash is dropping year after year, while the debt is just exploding upwards. In just 2 years, this company went from a healthy position with more cash than debt to having more than twice as much debt as cash. This is a business that's burning through its money and getting weaker by the day. It's literally the exact opposite of what you want to invest in. So, what's the antidote to all this scary debt? It's something called free cash flow. Basically, this is the actual, real cash that's left over after a company pays all its bills and reinvests in itself. A business with consistent, positive free cash flow, that is a massive green flag. It means they have the financial power to grow, pay you dividends, or get rid of debt, all without having to go begging for more money. All right, we've checked out the leaders, and we've gone through the balance sheet. Now, let's talk about the company's actual game plan. Is their strategy focused and brilliant, or is it just all over the place? Peter Lynch gave us another perfect term for a classic mistake. Diversification. You get it? This is what happens when a company starts buying up other businesses in fields it knows absolutely nothing about. Instead of making the company stronger, these moves usually just end up destroying value. So keep an eye out for companies that are constantly buying businesses in totally random industries, or ones that are just chasing the latest hot trend where they have no real advantage. A strong business should be able to fund its own growth from its own profits. If a company constantly has to sell more shares or take on more debt just to grow, its core business probably isn't as strong as it seems. And that brings us to red flag number 4. This is when the story about the company is amazing, but the price you have to pay for the stock is even more amazing. It is so easy to fall in love with a company's vision, but if you overpay for that vision, you're setting yourself up for failure. Lynch had such a great way of putting this. Hype is dangerous. By the time a company is on the cover of every business magazine and it's all your friends are talking about, well, the easy money has probably already been made.
The risk is sky high because everyone's expectations are just through the roof.
So how do we check for hype? One of the most basic fundamental tools out there is the price to earnings ratio, or PE ratio. All it does really is tell you how many dollars you're paying for every single dollar of the company's yearly profit. It's just a quick and dirty reality check on the price tag.
So, how do you actually use this thing? Well, a high PE isn't automatically a bad thing, but it has to be backed up by high growth. A good rule of thumb from Peter Lynch is to just compare the PE ratio to the company's earnings growth rate. If that PE number is way, way higher than the growth rate, you might just be looking at a seriously overpriced, hype-driven stock.
And that brings us to our final red flag, when a company's actions just scream that it couldn't care less about its owners. You have to remember, when you own a share, you are a part owner of that business, and the management team is supposed to be working for you. So how can you tell? Well, watch for them suddenly cutting the dividend without a really good reason. Check to see if the top managers actually own a lot of stock themselves. You want them to have skin in the game, right? And be really careful with companies that are constantly printing new shares, because that just waters down your piece of the pie. It's a huge red flag when executives get new options, even when the stock price is tanking.
The bottom line is pretty simple. Just watch what the insiders are doing. An executive might sell their stock for a million different reasons, sure, but there is only one reason they buy it. They think the price is going up. Widespread insider buying with their own cash, that is one of the strongest green flags you can ever hope to find.
So there you have it, a 5-step checklist to guide your homework. Investigate the people, dig into the financials, make sure you understand the plan, check the price tag, and please make sure management is on your side. Look, this isn't a shortcut. It's a roadmap for doing the real work that leads to much smarter investing.
And we'll end with one last piece of gold from Peter Lynch. Success in investing isn't really about being a genius. It's about diligence. It's about being curious, being thorough, and taking the time to look under the rocks that everyone else just walks past.
And that really leaves us with one final question. Now that you know what these red flags look like, the choice is yours. Are you going to approach the market like a gambler, just betting on hype and a gut feeling? Or are you going to adopt the mindset of a patient business owner, carefully turning over those rocks and investing for the long run? The answer to that question is going to define your entire journey as an investor.